Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, 25th of February. US and European equities rebounded on Tuesday as global investors digested the latest US tariff shakeup and the AI fear trade ease as well. Big technology saw action too. Meta announced a massive tens of billions of US dollar worth of AMD chip purchases to deploy up to 6 gigawatts of AI computing. That's enough to power 4 to 5 million homes. Nvidia earnings come next with fourth quarter revenue projected nearly 70% higher compared to the same time last year. Yet great results from Nvidia today may not ease the AI stress just yet, as investors want big technology to spend reasonably, and that per se is a risk for Nvidia's future outlook. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So US and European equity markets rebounded yesterday as global investors digested the latest US tariff shakeup and AI fear trade ease. LegalZoom, for example, which was one of the software companies heavily hit by the idea that Anthropic's Claude would wipe out its business, jumped 2.5% yesterday from its lowest levels on fresh news that Claude unveiled features this time that could be integrated into the company's products and make them more customizable and AI friendly. There you go. That's the brighter side of the medal, right? AI tools will enhance some of these software companies' products instead of replacing them, and the latter could eventually help these software companies thrive along with AI and not disappear. So iShares expanded software ETF rebounded close to 2% yesterday. The software stress overall is probably not over just yet, but opportunities clearly emerge. Now in the big tech space, it was a good day too. Meta announced to buy AMD chips, a lot of AMD chips, to deploy up to 6 gigawatts of computing power. Now, 1 gigawatt is basically the output of a full-scale nuclear reactor. It could power a small city. Meta is talking about the equivalent of 6 nuclear reactors just for AI computing. 6 gigawatts is enough to power 4 to 5 million homes. That's the size of the deal that Meta signed with AMD this week. The deal is worth tens of billions of US dollars of revenue for AMD and pushed the AMD stock price up by nearly 9% in yesterday's trading session. That was fair enough, and that's the good about this deal. The bad is that Meta is spending money against investors' will and is taking on debt against investors' will. So that's something that global investors are growingly uncomfortable with. Remember, more infrastructure spending increasingly financed by debt. And there's the ugly. The ugly is that Meta is receiving warrants that would allow them to buy shares in AMD if the company hits a certain performance target, and they could ultimately end up owning up to 10% of AMD. Again, the circular nature of the AI deals attract attention here. Everybody's hand is now in everybody's pocket, and the risk is that if one of these companies stumble, well, the whole group, increasingly running on debt, would wobble. For now though, Nvidia and AMD, these two chip makers, will continue to grow given the hyperscalers' huge spending plans in AI infrastructure involving their chips, and that despite investors' reluctance. But the risk here is what happens if the big spenders are forced or decide by themselves to spend less? Could a gap left by big technology be filled in by smaller spenders? Well, time will tell. The world is migrating toward AI, but the spending increase from outside the big technology companies is obviously more granular. Anyway, today Nvidia will bring an answer to how much chips they sold last quarter and how much money they made. Their fourth quarter revenue is projected near 65.6 to 66 billion US dollars, which would be a nearly 70% growth compared to the same time last year. Now, note that this company's earnings was near 67 billion US dollars before the AI bust started. Today is 10 times more and growth is expected to continue. But even though all sounds great, investors won't just cheer the headline results. Because last quarter, remember, Nvidia delivered strong top line numbers numbers, yet stock didn't fully ride the wave. Why? Because investors zoomed in on the details, specifically the widening gap between revenue booked and cash actually collected by Nvidia. And that matters in a world of rising leverage and massive AI capital expenditure. In this environment, investors don't just want contracts and revenue promises, they want cash in the door. So yes, Nvidia has built a track record of meeting and beating expectations in this AI cycle, but this time again, it won't just be about revenue growth or EPS beats. The devil will be in the details. Cash flow, receivables, margins, and forward guidance. Well, forward guidance will probably be strong. But broadly, Nvidia's results will pretty much mark the end of this earnings season in the US, and the numbers actually do look strong. In the fourth quarter of 2025, the S&P 500 companies printed a 13.2% earnings growth, the fifth consecutive quarter of double-digit earnings growth. Other good news is that the rally has also spread to non-technology pockets of the market. The S&P 500's equal-weighted index has mostly closed its gap with the technology-heavy and market cap-weighted version. Looking at the pricing, well, the S&P 500 looks toppish since the start of the year due to the AI fear trade, both regarding big technology and the software space. And indeed, the latest AAII Investor Sentiment Index confirms that the bears took the upper hand on the bulls for the very first time since November last year, hinting that most of the selling may have been already done. So that's quite good news. Yeah, it remains the fact that the major US indices need technology to perform well, as the Magnificent Seven companies make up to a third of the S&P 500 index, and without their precious support, the gains led by rotation could be marginal. Now, looking at the economic data, the Conference Board survey pointed at improved sentiment in the US in February, while Home Depot warned that their customers, which are middle and upper income homeowners, are actually worried about housing affordability, job stability, and higher financial costs. Regardless, Donald Trump said at the longest State of the Union speech that he delivered yesterday that America is bigger, better, richer, and stronger than ever before, and that they're winning so much. We are winning so much, he said. The US dollar, however, weakened in Asia this morning, pushing the euro dollar to 118 level. The dollar yen was offered near the 156 level, retracing earlier gains after Takaichi voiced apprehension regarding more rate hikes from the Bank of Japan that would temper the impact of her expensive fiscal plans aiming to boost growth, and nominated two reflationist academics to join the Bank of Japan's board, suggesting that whatever happens with the dollar, well, the dollar yen will still be under a positive pressure. While in Australia, the Aussie dollar jumped past the 0.71 level on stronger than expected CPI numbers released this morning, reviving the Reserve Bank of Australia hawks. Today, the euro area CPI figures are expected to confirm a softening euro area inflation in January that could eventually allow the European Central Bank to step in if the trade tensions with the US flare up and threaten economies. But for now, the ECB is in a good place, and the STOXX 600 index doesn't look like it needs any help from the ECB just yet. It's trading near an all-time high level right now, also supported by stronger than expected economic data and shrugging off the Trump's latest tariff threats. Anyway, today, all eyes are on Nvidia's earnings, obviously, and the market's willingness to see the bright side in the earnings. SoftBank is down 0.83% at the time I'm talking here, and more than 40% since its November peak. And I'm afraid to say that, but Nvidia alone may not be able to reverse the AI worries of the moment. Because yes, AI spending remains strong, and that's cool for Nvidia, but investors are pulling away, not from Nvidia, but from its biggest clients. And given that the hyperscalers make up to almost 50% of Nvidia's client book, I would argue that the AI stress around leverage investments will not be over just yet. But let's see. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the Nvidia's earnings, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.